which leads me on to strategies for accumulators and retirees. So it is not easy with the different structures and the different areas that you can invest in or to have in place. You have your personal assets, which you can have in your own name, where tax is up to 46.5%. You've got the company tax rate, anywhere up to 30% round figures. You've got super and self-managed super funds, where tax rates start at 15% and go all the way down to 0. You've got family trusts, and it is easy to get it wrong. And so one of the important things is to say, well, okay, look, get advice in relation to where should I have my money invested, or where should I have, how should I be structured? And that's where, whether it be Roy or Katrina, sit down with you and say, well, okay, based on your circumstances, this is what we need to have in place. Actually, the one point I will make on that, and I know, Paul, you mentioned this earlier today, was and actually, I'll throw over to Roy. Roy, we often see where people try and do it themselves and they end up with the wrong types of structures. Did you want to just spend a few seconds on how hard it is to clean that up and get people back into the right structures that they should be in?
Yes, Tony, if you don't get the building blocks right at the start, then you're going to be all over the place as you go forward. And unwinding can be messy and difficult. And it's one answer doesn't fit all. The questions we're going to ask about family, ages, what we're trying to achieve. Are we wanting to sell out the business? Is that what we're trying to achieve? We're trying to make profits, which we normally are, but is the real profit's going to be on sale throughout the business life? There's so many questions and circumstances that you need to consider. We know we have one target from a tax planning point of view. We'd like to have the lowest tax possible. And that will often mean moving money into a lower tax environment or to super that's going to be zero tax when you retire. And as you get closer and closer to retirement, that becomes more and more critical. So yeah, it's a case that one structure doesn't fit everybody. You have to be specific to the person's circumstances.
And do you see that changing throughout their life cycle as well, Roy? Depending on where they are, what's going on?
It actually does, because when you might be a 30-year-old just going into business or just starting up as a carpenter in business, even working for somebody, your goals are not going to be as focused on superannuation and retirement as they might be focused on getting the next work van or getting enough for a deposit on a house or getting a residual income so you can fund some children's school fees. So those focuses, super's always going to be there with a 9.5%, but the focuses shift through the life cycle of any individual. Yeah,
good point. So there's not only is it not one answer for anybody, but it's not the same answer the whole time.
Correct. It changes as their circumstances, ages change.
Yeah, good point. Thanks.
So what can we do? And one of the things that we can do is smooth the purchase price. So that is dollar cost averaging. Now, and that's dollar cost averaging is the purchasing of assets on a consistent basis so that you have a smoothing effect, because obviously the prices of things are never smooth, so they go up and down, and you'll end up with the average price. And I can tell you now that I have since this pandemic started, so I'll say late February, certainly early March, is that I've had I've got a list of clients. In fact, clients that have written into me, 35 of those actually that have written into me to say, look, I've got $10,000, I've got 20,000, 50, 100, or whatever the amount is, looking to be able to purchase in. And some people have found it somewhere. There's some clients I'm really surprised about, and what they're looking to do is take advantage of this downturn, and by doing that, they're actually lowering their cost base and gives them a lower average price as well. Because this downturn that we've just recently seen and had, I'm not saying it's over yet, but certainly from where we've been, is that that has taken us back from a overall market point of view, back, well, it took us at one point back 7 years. In saying that, we are now back where I think as of this morning, before today's, I think we were up 2.5% not too long ago, but before this morning, we were down 7% over the last 12 months. So buying in at a lower base certainly helps your cost base and smooths out the average price. take advantage of the benefits of compound interest. From little things, big things grow. I know Paul loves this graph, this is a graphic of investing $10,000 and the difference of investing within the index versus getting an active return. And that active return has been 3.5% higher return on a per annum basis over that period of time. And so over that period of time, we've seen this fund return 13.4% on a per annum basis. We saw that the market did about 9.9%, so 3.5% difference. The difference in overall outcome is 4.4 times the wealth.
That doesn't sound much until you say the number.
No,
800,000 to 3.6 mil. That's a big jump.
Significant difference.
But for 3.5, and I've been in meetings where, you too, KP, but with Tony, where clients have said, 3.5% is not a great amount, but you look at it compounding and what a difference it makes. Tony, what sort of things are you doing to make that difference there? That, it's not much, but geez, it adds up.
It adds up, and so I'll talk about the investment committee side to begin with. The first thing that we look at from the investment committee is looking at good companies and looking at good companies with strong balance sheets, looking at good cash flow, and then looking at, we take into it, so from an economic point of view, we also take into account currency, we'll take into account GDP, we'll take into account unemployment, we'll take into account economic factors around that to come up with portfolios, different portfolios, because no one portfolio is the same for two people. So we'll come up with a number of different portfolios. And so as an example, if you're sitting in front of me as a client, I'll look at your circumstances. So like, okay, look, I think, and KP will do the same, based on your circumstances, we think we need A, B, C, and they're the portfolios we'll put together. And that is from that perspective where we come up with the relevant funds. The one thing I'll also talk about, and I'll talk about, and it also relates to dollar cost averaging and also markets. The one thing is in relation to superannuation. And I know it's a relevant topic at the moment, is the people taking out $10,000 out of their super at this stage to help for lifestyle, or lifestyle is probably the wrong word, living expenses. I'm going to use an example. I had a client call me and he said, look, he said, his name's Rod. Rod called me and he said, look, somebody at work's taking $10,000 out of their super. Do you think it's a good idea that I do that? And I said, Rod, I don't know the other person's circumstances, but tell me about why you think, and what would you do with the money? He said, oh, look, I'd take it out of super and I'd then pop it onto my mortgage. And then I proceeded to explain to Rod why that is not a great idea at all. And this graphic actually goes a long way to explaining that. At worst, let's say he's paying 3.5% on his mortgage. All right, it's not more than that. It's so 3.5%. Whereas he's got his superannuation that will compound over time. Now, Rod is 50. He was 50 last year. 50 last year. So he's got 15 years to retirement, give or take. And the difference of compounding up 15 years versus the difference of compounding down over that period of time at 3.5%, there's a significant difference. So as a result, and he got it straight away. He said, no, sorry, I called. It's all good. I've got it. And away you go. However, it's a relevant point at this point in time. So for those people that are actually still thinking about being able to access a super, only if you're extremely desperate and you need the money to live, to put food on the table, that's probably the only reason that I'd look at it.
Yeah, thanks, mate. You've answered a couple of questions that have been coming there as well.
Click back. Here we go. And so take care of your nest egg. So wealth strategies to take care of your nest egg. I will say this is that, and we've spoken a little bit about superannuation. I'm not going to spend too much time about this because this is a whole different presentation in its own. And we will spend time and we will have a separate superannuation presentation. But the one thing that I will say is that we're now sitting in June. For those people that do certainly understand it, the question I'll ask you is, are you maximizing your superannuation contribution caps? For those people that don't understand, please get in contact with your RJS accountant and ask a question, and also get in touch touch with your RJS wealth planner as well, and they'll be able to assist you in terms of looking at that as well. We talk a little bit more about superannuation. I'm going to pass over this because of the interest in time, because I do want to get to some of those questions that are coming through. So I will actually talk about the next step is debt, and not all debt is bad debt. So the one thing, as I touched on earlier, was an example of a client wanting to potentially take out money and pay it down into his home loan at, let's say, 3.5%. The one thing that we do know at the moment is that debt is cheap and borrowing is cheap. So the ability to go out and borrow is there if you've got the right cash flow. Now, with every strategy, as KP has mentioned, everything that we do from a planning perspective is based on cash flow. We've got to be able to have the cash flow to be able to do those things. So the first thing that we'll look at is cash flow, and the question that we'll ask in relation to your goals is, what are you looking to achieve? And if it is, look, I want to pay my home loan down faster. One of the common things that we do come across is, look, what I want to actually do is I want to pay my home loan down off first, and then once I've paid that, then I'll look to do something. And what you'll hear from us is that you can have your cake and eat it too. And you can do that today based on cash flow. And the advantage you have is that we can actually then, as a result of that, and this is one of the strategies that the team will discuss with you in person, is that we can actually pay your home loan down faster as a result. So that's something that is certainly available, and something that you can take advantage of in the current low interest rate environment.
Yeah. So a good question I've heard you ask Tony in meetings, and I love it, is who's actually setting your debt structure? Is it you or the bank?
Absolutely.
It's a vastly different structure if you're taking control of it, instead of having the bank run it.
Yeah, and that's where, even from a wealth perspective, if you're getting your home loan looked at or whatever the case is, have a chat to an advisor, because the advisor the advisor will bring a certainly a different lens in terms of what we're looking to do or what you're looking to do. And at worst, if it is what it is, no problems, but at least you've actually sought that advice and got it. Whereas what we tend to find is, look, people just go into their bank or see a broker and say, well, okay, look, go have I'm after this, and you'll end up with what you've asked for. I know the RJS lending team is fantastic in terms of regularly chatting to the advice team and saying, well, look, this client's looking for this. Is this the right structure? Should we look at this? And then we can actually look at that combined from a wealth as well as a finance perspective as well.